Okay, once again, this is managerial accounting, counting 305. This is our first in-class session here. Everyone see the first lecture on Moodle. I know it's boring. It's just kind of just getting through some terminology and stuff, not really any equations or any mathematics or any problems we had to work through. This chapter does get into a little bit of like cost of goods sold, cost of goods manufactured, and stuff like that. It also has a lot of just terminology on slides, so just bear with me. I know it can be boring. I'm going to try my best not to just read off the slide and kind of veer off. But when you're just dealing with the basic terminology and stuff, it's kind of hard to really say a whole lot without just maybe twisting the meaning or something. So just to me, I just like getting to the point. I don't like dragging stuff out. Get you what you need and practice the harder things and move on about our business. So I'm going to try to get through it. It is a lot of slides, and we'll see. I might do the same thing and skip like the examples in the like in your real life and stuff. How you all noticed I did on the last thing, and just let you read through it. We might read through it. I'll just see how we're going, because I'd almost rather spend the time on actual like the calculations of calculating stuff that you're gonna see more so on the quizzes, homeworks, and the exams. Has everyone taken quiz one or seen quiz one? I think I know only one person has. Have you all noticed that it's posted or seen the homework or anything? You still have till Friday for chapter 1 quiz and chapter 1 homework at 11:59. Chapter 2 homework and quiz is posted. It's not due until I want to say next Monday, so that's going to kind of be our routine moving forward. I'll post stuff right before class, like the homework and the quiz, and then you'll have till the following week after class at 11:59 at midnight to get it in. And the reason why I want to do that is because my hopes are is to get through the content. Like today, we'll get through the slides. I'll assign you some homework, and then we'll come in and spend the first little part of the class on the following week going over like homework questions or any questions you had on the quizzes or anything like that. If you've even taken it, we'll just do the homework, not the quiz, because I know that's not due till later. That won't be due till later. But the homework, that way you can make sure you get your full credit on your homework. I still would say attempt it before you come to that class on Monday, so you have your questions ready, because I don't really want to just repeat another lecture that I just did the previous week. So just attempt your homework. It'll help you on your quizzes and on your exams. Moving forward, what you see on the quizzes and homework is what you can expect for the most part to see on exams. I don't like throwing any surprises or any curveballs out there. So that's pretty much what you can expect to see on the exams. There'll be mainly multiple choice questions, and there might be some very short answer ones. But we'll do detailed reviews the session before we have the exam or whatever. I haven't decided if I'm going to do the exam just through ProctorTrack online, or if I'm going to have people actually come in here and sit down and take it. I guess it'll really just depend how we progress through the semester and how we're covering the material. If we need an extra day in class, then we might move it and just let you take it through ProctorTrack at your house or wherever, but it'll have to be through ProctorTrack. It's free. It's not going to cost anything to sign up, and I'll have all that loaded up here at the top of the shell so everyone can see it if we decide to go that route. Did anyone have any questions about chapter 1? Really, I know it was pretty much straightforward. Anyone have any questions or concerns about that before we move into chapter 2 material? Everyone's good. Okay. Well, and before we get into that, let me also say I know we had to do that introduction post on that forum by like this past Saturday, but since we're just first time in person here, I'm going to try to interact with y'all as much as we can and talk, so it's not as much of a boring class. The first couple classes is going to be kind of hard to do that, because like I said, we're just getting through some basic terminology and stuff. So let's just kind of just go ahead and break the ice and just introduce yourself, and if you want, just tell where you're from or what you're interested in and stuff, and whoever can start, it doesn't matter. You can just there's only 4 of us in here right now, and then I need to take roll while you do that as well, so that I can kill 2 birds with 1 stone here. So let me go ahead and write your names down as you all want to just go ahead, and whoever wants to take the mic now and go on ahead.
My name's RJ Rohr. I'm from Salem, Virginia.
So that you're RJ? It's hard to tell with these masks on. Okay, it's like playing games here. So I knew it was on this side of the room. So you're RJ,
yeah.
And you're from
Robert, but I don't know what it's on the. I know about RJ.
Robert, and what's your last name?
Rohr.
Robert.
RORRER.
Okay, and RJ is what you like to be called?
Yeah.
Okay. Next, Dan.
I'm Tyler Mullins from Glendale, and that's about it.
Cool deal.
I'm Bryce Painter. I think I know everyone except for you. I went to
I've had you in the
last
entrepreneurship
year.
class,
Yeah,
yeah.
it was a little difficult
Was it?
studying abroad.
Well, yeah, I bet. Yeah, that's right. You were right. We appreciate your service. Though. I
Yes, sir.
remember I was
Thank
dealing
you.
with your sergeant back and forth. He was the little person in between me and you. So yeah, nice meeting you. Appreciate
Yeah, so
it.
it's nice to have a face. With,
Yeah,
the
same
class.
here, Bryce. Yeah, because I worked with two people from a distance, and one was somewhere else, but one was overseas. So I appreciate your service.
Yes, sir.
And nice putting a face with the
For
name as
sure,
well.
for sure.
Appreciate your hard work last semester too. So Bryce, that's Bryce Paintner, and you are.
My name is Jacob Webster. I'm from here in Bluefield.
Okay. Well, I'm Nathan Taylor. And like I said, I'm your instructor here. I was actually born and raised. I was born up here at Bluefield Regional, long time ago. No, I'm joking. Back in '85, but I was born and raised here. I graduated from Graham High back in '04. I went to WVU. I studied finance, accounting, and economics there. So I did a triple degree there with that. And then I got my master's of accounting from the University of Alabama at Birmingham. And I am currently studying for my state board for my CPA. So that's a little bit about my background. Pretty much I've lived here, lived in Morgantown obviously for my duration in college there, and then I lived in Williamsburg, Brooklyn for about 3 years. So I've kind of had a nice little time spending in the country, a little bit bigger of a town, and then ultimately in one of the biggest cities in the world. So it was cool. Feels good to be back into the country. That's God's land there. You know, nothing like being in the country. Not as much to do, but you got to give and take. So that's a little bit about me. Nice hearing you all. Introduce yourself. Put a name with the face here. So we'll go ahead and we'll just hop right on into chapter 2 then. So just keep moving on that. One other thing I'll just show you. I'd like to just do a little review here before I get into it. That's what we did in chapter 1 for the most part. The homework, remember, it's due. I believe this Friday is when it's due. Here's chapter 2 homework. Here's the chapter 1 quiz down here in the beginning of this week. So that's pretty much the same layout we're going to be moving going forward for the class. Any questions on what the layout of Moodle, on how it's organized? Is it pretty straightforward, pretty easy? Because I know I've saw some of the instructors' pages, and they were just stuff was everywhere. So I tried to make it as neat as possible for you all. So hopefully you can understand everything on it. Let's go ahead. Here, I'll get where I'm at. Okay, so chapter 2, basic managerial accounting concepts. Once again, just bear with me. I'm going to try not to bore you all with this. So we'll try to just bang through it. And if we need to take a break, like midpoint, if you're just getting tired of sitting or something, we'll take a break. I'll check in with you in a little bit when we're about halfway through the slides and see if y'all want to take a little break, or if y'all just want to just hammer down and just try to get out of here, and maybe even try to get out a little early or something. So we'll just see how that goes. So we have 3 learning objectives for this chapter. We want to explain the meaning of cost and how costs are assigned to products and services. Define the various costs of manufacturing products and providing service, as well as the cost of selling and administration. And then lastly, prepare income statements for both manufacturing and service organizations, because they will differ between the two. Okay, so the meaning and uses of cost. And obviously all these are posted, so just unless there's something that's not on here, you don't need to worry about taking notes or anything. Just like I said, it's just something that sticks out from outside of this, because all this is on the website, so you don't need to worry about it. Determine the cost of product, services, customers, and other items to managers. So obviously cost, we know that's everyone understands what cost is. It's just pretty much the cost of something that we purchase, right? So whether it's just materials, a service, whatever it might be, it's just an actual cost. Or cash equivalent for the goods or services that we're going to bring benefit to the organization in the future, right? So just the cost of buying something, that's pretty straightforward. As costs are used up in the production as revenues, they're said to expire, so meaning it becomes an expense, right? I'm sure everyone's heard of an expense at this point within your business career here at the school or working or whatever. So pretty much as costs expire, then there's those expenses on your P&L or on your income statement. So once again, on the income statement, expenses are going to be deducted from your sales, obviously, or your revenues to give you your gross profit, right? So we're all familiar. I mean, I know y'all said y'all are management students here, but you all have had principles 1 and 2, right, of accounting. So we all know the income statement starts with your sales, and then from there we back out our cost of goods sold, right, the expenses of the actual cost that we're selling. We can look more closely at the relationship between cost and revenue by focusing on the units sold. So the revenue per unit is called price. So we know that when we buy something, that's how much it costs, and then when we sell it, that's how much we're going to charge people for it, and that's ultimately the price that we're going to charge people, right? So just basic terminology here, just cost, price. I think we're all solid on all this so far. Here's how it's used in your life. We'll go ahead and read through these so we can maybe talk about it a little if we need to. Making financially sound decisions requires that the costs associated with those decisions be clearly identified and accurately estimated. The exact purpose or decision for which the costs are being estimated must be determined. So this is known as cost objects. So pretty much all that's saying there is we want to know we want to be able to like trace our cost to an object, right? So like if we're buying like wood to be able to manufacture furniture or build a deck or something, we want to be able to trace that cost directly to that wood, and specifically each item within that wood, 4x4s, 2x4s, your screws, whatever it might be. So that's what we're talking about, the cost object, being able to trace the cost to a particular object there. Individuals as well as businesses must understand cost objects for various personal decisions. A good example here is a prospective college student. Hannah wanted to know how much it would cost to obtain a college education, right? Pretty much long story short with this, I'm not going to read through the rest of it. So that's the start of it. So the scenario it's set up is this girl, Hannah, wants to go to school, right? And she's trying to determine the cost of going to school. Well, she asked numerous different people, some friends, some family members, and all of them gave her a different example or a different price of what the overall cost would be to go to college. Why do you think that each individual, like her friend, maybe her parents, or a banker, I believe is one of the ones she asked too, why would each of them give her a different price instead of just like a uniform price? What are some factors that could determine to determine different prices instead of just one? Scholarship would be a net reduction in the actual cost of attending. So that's a variable. What else could determine into it?
Room and board.
Room and board, right. How about out-of-state tuition, versus in-state? Some of the people were factoring in like auxiliary things, like going out to the clubs and having beer money or whatever your little itch is or whatever, so it's just having extracurricular stuff, where others didn't include that. The banker even introduced the concept of opportunity cost. So what's opportunity cost? Does anyone know what opportunity cost is?
It's the cost of something you gave up.
Right, in order to make the other decision, right? So, that she said, well, you have to look at what you could make while you would be in school, as opposed to giving that up to what you would make when you get out. So all these are just different factors pretty much that are going to enter into the girl Hannah's decision on going to college. So she needs to just hear these different opinions from people, and then she needs to decipher out what's going to be relevant for her decision, right? Because it's different for everybody. Some people might be really big partiers. It might be really important to them to go out on weekends to blow off some steam from the classroom in the week, and some people might not. So that might be an expense that some people realize, some others might not. So stuff like that is going to enter in her determination of if she's going to go to school, where she's going to go to school, when she's going to go to school, and maybe how. Is it going to be online, or is she going to go to a brick and mortar campus? So stuff like that. No different for in a business. If we're going to produce something or manufacture something, we need to know what that cost object is and be able to know whether we're wasting money on an object, whether it's even necessary to bring it into production, or if there's a substitute. So you get where I'm going. That's pretty much what this example's talking about. There's a lot of variables that we need to know whether they're necessary or unnecessary, because the whole point of the cost on managerial side is to keep it down, right? So that's that. That makes sense for everybody? So now we can skip a few amount of slides there. Okay, so accumulating costs. So accumulating cost is the way that costs are measured and recorded. Okay, so what do we mean by accumulating costs? So let's think back to like our principles of accounting classes, right? So when we accumulate something or accrue something, what does that actually mean? We know a business has many costs throughout an operating period, right? Operating period, I mean a week, a day, a month, but usually it's broken down to months, quarters, and years, right? So they have many different expenses. So when we have all these different costs and expenses, they accumulate up, right? And we accumulate them in accounts, right? So the say, for example, here, the accumulated cost, saying in this instance, is going to be a phone bill. Okay, so how do we want to account for that? So we know we're going to have maybe an accounts payable on our balance sheet, right? So maybe we're not paying for it up front. So we're not, we owe for that bill. But there also has to be an expense account on the income statement, right? That accumulates that expense for a period. And at the end of the period, that expense account starts over at zero again, right? And then it reaccumulates again the next period. So that's what we're talking about, how we accumulate cost. They're going to be accumulated within the accounting system, and that we should be used to that from financial, like the principal side. Does that make sense? Because we're going to hit the expense account, and it might just be an expense, and then pay cash out the door would be the credit, so it wouldn't affect the balance sheet other than the reduction in cash, or the liabilities would increase with if we did it on account. Does that make sense? How we accumulate costs? And at any time, if I'm going too fast or something's not making sense, just stop me. I mean, it's what we're here for, is just to talk. Like I said, I don't want to just bore you all and run through the material. So what about assigning costs? So once again, assigning cost is just assigning it to an object, right? Just like a cost object. So now we figured out what the cost object is. Now we need to assign that cost, right? So what is the cost object for the phone call? So let's say that in this instance, to support manufacturing. So if it's to support manufacturing, then where's that going to be included in cost? What component of cost is that going to be in? I know we haven't got to it, but just off the top of your head, where do you think if the phone call was made to support manufacturing, how are we going to account for that as a company? Think about when we manufacture something, right? What are we doing when we manufacture something? We're creating a good, right? Like, so we're taking a raw material and we're creating it like it's,
Cost of goods sold, maybe?
it will enter into cost. Who said that? Okay, it's going to enter in. That's the ending point on the income statement. But before that, what has a direct relation to cost of goods sold on the balance sheet? Income statement's cost of goods sold. What is it in before it goes to cost of goods sold? Think about, what is your cost? What are you selling? A company's inventories. Okay, so if it's to support manufacturing, it's going to be a production cost. Production costs are then turned to inventories because it's your completed project, right? So we're producing these products to sell. So if we're manufacturing, we're taking them from raw materials. Say if we're a furniture manufacturer, we're going to get that raw lumber, right? We're gonna convert it into a chair or a couch, right? Within that process. So if we're making a phone call to a manufacturer, like, hey man, how many pounds of lumber did you give us again? Then that's gonna enter into production because it relates to that. So that part of that phone call right there needs to be charged to the production, which will enter into the inventory, and then it's held as an inventory cost, right, on the balance sheet. And then when the point of sale, it's charged to cost of goods sold, which is underneath what we just got back to, underneath your sales at the very top of your income statement. So that's how they interrelate from the balance sheet to income statement. It's just being held there until it's realized. So supporting manufacturing, it's going to go into production cost, ultimately into inventory, and the end result cost of goods sold. Does that make sense? Okay. What if it's to support selling the product? Where's that going to be charged to? This one's a little easier, more straightforward than the other one. If we're going to sell the product, what are we going to charge it in? It's going to be a selling expense, right? Because it's broken into different categories on manufacturing. We're going to have the productive ones, right? That enters into inventory, what you're producing, the manufacturing ones, those costs. The next, the selling expense. And then we have the general and administrative expenses as well, right? So, and we're going to get into that later. But the selling the product, that's going to be charged as a selling expense. So that's how we want to know the object, because when we look at these statements, or we want to deliver these statements to the upper management to make these decisions, we want them to know, okay, well, part of this cost is for this, part of this cost is for selling and administrative, so some of it's for just general and administrative, whatever it might be, because that's how you break it down and can infer the difference between your gross profit or your operating income, and we'll get into that later. So that's all that's saying by assigning cost. It's very important because it tells management a lot about the cost of what activity it's tied to. Does that make sense? Everyone good? You sure? Okay. So cost objects, a little more on this. pretty much managerial accounting systems are structured to measure and assign costs, right? So a lot of the work's been done in the coding already. So, I mean, these systems are awesome once you get out there and start working. I mean, it pretty much does everything for you for the most part. I mean, you still have to know the theory behind it and be able to, know what you're doing to be able to input the data into it. But the systems really do just really pretty much take the driver's seat a lot of times and just take care of a lot of this stuff that we're learning. A cost object is any item such as a product, the customer, the department, project, building, whatever it is, right? So like we just said, if it's for a phone call dealing with manufacturing, it's going to be a production cost. If it's a phone call trying to sell the product, it's going to be a selling cost. So that's what it's saying. The cost objects could be anything that's part of that company, right? So what's a cost object?
It's something that contributes to a cost of something else. So like, like the selling, goes into sales expenses and stuff like that.
Yeah, right. The cost object is anything. It's like it says, it could be a product, a customer, department, project. So it's just a cost object. Like I said, that phone call, the cost object of that phone call, the first one for the manufacturing, dealing with manufacturing, was the production cost, right? So that dealt with the production side. So that's all it could be. The cost object is any object you're trying to tie a cost to, and it can be anything. So that's what a cost object is. Assigning cost to cost objects. Cost can be assigned to cost objects in a number of ways. Pretty much the method depends on a number of factors and the need for accuracy, really. So how accurate does it need to be? So there's different factors that can enter into determination of it. Pretty much the objective is to measure and assign cost as well as possible, giving management objectives, right? So we have these objectives as a management team, right? And we're trying to accomplish those objectives. So in order to do so, then we need to be really be specific in how we're going to cost these, right? Because if something is really a selling cost, we don't want to include it in inventory, right? Because then that's going to throw off our whole gross profit, which determines everything else underneath it on their income statement. And that could really just throw your company into a really bad spot. So that's why it's really, really specific where we do this, especially at this point, because this is the top of your income statement. And like I said, that determines all other expenses being absorbed for the company, which ultimately determines whether you're going to have a net income or a net operating loss at the end of the reporting period. So it's very important. Let's talk a little bit about Delta, how it's used at Delta. So for which business activities do we need an estimate of cost? So let's just assume that we're the chief financial officer for Delta Airlines. So managing the company's numerous costs is critically important for the fiercely competitive airline industry. So therefore, one of your major tasks is deciding which costs to manage in order to achieve the company's profitability targets. So in other words, you must identify the airline's most important cost objects to track, measure, and control, okay? So it says here, which cost objects would you select as critical to the company's success? So here it says certain airline cost objects are obvious, such as the cost of operating a flight, which includes jet fuel. I found this number pretty crazy here. Delta spends over $10 billion annually for jet fuel. That's insane. That's a pretty big expense right there. And labor costs for pilots, crews, maintenance staff. So that's a lot. However, the cost of these obvious cost objectives can become challenging, right? So even though they're that big of a cost objective, it can become really challenging for Delta. So for example, when an airline operates multiple types of aircraft, it incurs additional costs to train workers and store spare parts for each aircraft type. Makes sense, right? Because each aircraft, you have to know what, the tendencies of the aircraft and all that. So you have to have different type of trainings for different types of pilots, right? So that's a factor right there. Airlines might even be more specific with certain cost objects, such as when they focus on the cost per available seat mile. So in that industry, they charge you by the seat mile, I guess. And that says here it's about 6 to 10 cents per range for the range of most airline companies. So that's about what your average, I guess your average costs about 8 cents per mile, what you're paying to fly on a plane. Other airline cost objectives are even more challenging. For example, you likely did not include the cost of managing crisis as an important cost object. But according to the International Air Transit Association, the airline industry took an estimated 1.7 billion hit from disrupted airline travel resulting from volcanic ash cloud caused by the eruption of the Icelandic volcano. And if anyone can pronounce that word, That's pretty impressive. So I'm not even gonna try to do it. Can anyone want to just take a stab at that? I don't even know if that was just a misprint. I mean, that's I don't even know how you would say it or anything. But anyways, so like I said, there's other unknowns we have to account for too, like natural disasters or anything like that. So they're saying they lost a lot of money over just the volcanic ash floating around in the clouds or in the sky. So I guess maybe they had to just revert around them, go over them, whatever it might be, which caused them extra money. And then finally, you might want to consider the cost object of processing customers, such as boarding and deboarding passengers and loading and unloading their baggage. For example, airlines have charged fees for using curbside check-in services, consuming soft drinks during the flight, using pillows, blankets, selecting seats prior to the day of the flight, and checking bags. Spirit, I don't know if anyone's ever traveled on Spirit Airlines. They raise many customers, even the regulatory eyebrows, by being the first airline to charge passengers $45 for a carry-on. So I'm sure everyone that has flown before knows if you check your bag, you have to pay usually a flat fee to check your bag, and it can't weigh over a certain amount of weight. I think it's 50 pounds, something like that. So like any other company, an airline can identify and manage any cost object it so desires. Sometimes the most difficult part of effective cost management is the first step, deciding on the exact items for which one needs to understand the cost. Mistakes in selecting the cost objects almost always lead to poor decisions and subpar performance. So once again, if you get the cost wrong from the beginning, it's going to throw off what you can charge people as far as your price for your product, which is going to, in the end result, going to have a huge effect on the rest of your operating success for your company, because that's going to determine how much money you have to spread out over all your other costs to bring that good or service to market. Make sense? I hope that Delta example helped a little bit. I'll try to read through them. I know it's kind of boring just hearing me read, so I apologize on that again. Does that help though? Hearing that example of just the different scenarios, like their gas being so, or their fuel being so expensive, the little volcano ash, just unknown. So it's just stuff like that can come into play. So now let's talk about some direct costs. These are costs that can be easily and accurately traced to a cost object. So, for example, like if we buy lumber, then we know that's easily that we can trace that directly to the cost of that lumber, right? So when a cost is easy to trace, we mean that the relationship between the cost and the object can be physically observed, easy to track, and results in more accurate cost assignment. So like I said, this is easy stuff. You know, if you buy a product or a service and you can look at it, it's got something tangible, that's pretty easy to determine what the cost object is, and you can trace the cost easily. So that's direct cost, pretty simple. The next one, indirect costs, obviously, it's going to be the complete opposite of direct costs. These are going to be harder to trace, and you have to actually allocate these. So indirect costs, you know, the indirect costs, some of the examples are like the accounting and legal expenses, like salaries for your personnel, like your executives and management and stuff of that sort. The direct costs, on the other hand, is going to be like your manufacturing supplies, equipment, raw materials, and stuff of that sort. So those are going to be the ones we can directly trace. And obviously, with the examples of the indirect costs, how do you determine the accounting and legal fees, how you spread that out across all those goods and services? You know, so you have to have some type of a system of allocation to be able to do so. Allocation means that an indirect cost is assigned to a cost object by using a reasonable or convenient method, and we'll get into the different methods later on within the semester. Allocating indirect cost is based on convenience, so we always want to make sure it's convenient to do so, right? We don't want to make anything harder than it already is, or just do unnecessary steps involved. We want to keep it as simple and as lean as we can. Everyone good on direct cost and indirect cost? So what's the difference between the two again?
Direct is something easily traceable, indirect is not.
Right. And indirect, how is that going to be? It's going to be allocated, right? Okay. Here goes just a little object costing, so just pretty much just showing you here. You can see direct cost, direct tracing to the cost objects. Indirect costs, we allocate them to the cost objects. And then, of course, the cost objects could be customers, products, territory, department, whatever it might be. Everyone good on those? That's just a little picture there. Sorry, my throat's getting dry. Am I boring everyone yet? Okay, so let's talk about how it's used at Little Guys Home Electronics. So returning briefly to the Little Guys Home Electronics business from the previous chapter, the prices set by Little Guys management are heavily dependent on understanding the company's costs, both traced direct and allocated indirect for each product. The more difficult costs to estimate and use appropriately in setting prices are the indirect or overhead costs. So according to David, a partner in Little Guys, the most difficult part of pricing is deciding how to accurately the indirect costs. Oh, that don't make sense. Whatever, such as inventory, warehouse, the support role, employee labor, store insurance, delivery, truck maintenance. So that's going to be his biggest challenge here, right? Is trying to learn how to allocate these costs right here, the indirect costs, and the rental. Healthcare, they've all been allocated to the home electronics products. For example, management believes that too few indirect costs have been allocated to a set of the Cliff speakers, then the speaker cost is marked up by a greater percentage than if the correct amount had originally been charged. Therefore, accurately tracing direct costs and allocating indirect costs to products and services are important for many management decisions. So pretty much, they're just saying here, you just want to make sure that you're just allocating your costs correctly here. I didn't really like that example. So let's talk a little bit about other categories of cost. So obviously they can be direct or indirect and are analyzed with respect to their behavior patterns, or the way in which cost changes when the level of the output changes. So we have three different types of costs here: variable cost, fixed cost, and opportunity cost. So before looking at it, what do y'all think a variable cost is?
Something that changes depending on how much of something you make.
Right. So as you produce more, your cost is going to go up. So like if we're producing furniture, for example, keep on that example, the more furniture we produce, the more wood we need. So that's a variable cost. That's going to go up, right? Because we need more wood to produce more furniture, obviously. What about fixed costs?
It happens every time you
Right.
use a
No
product.
matter what, it's the same, right? It's verbatim. What's a good example of a fixed cost? Huh?
The wood.
Mm-hmm. That could be fixed if we're at a fixed output. But let's say like salaries. Remember, like if like someone's paid a certain salary, it's not going to really matter if we produce 1 unit or 1,000. That worker is going to be paid the same. That's a fixed cost, right? Stuff like that would be a good example. What about opportunity costs? We talked about that. We know that that's the cost foregone when you choose one alternative over another, right? So those are just other categories of costs. We have the variable, fixed, and opportunity. So everyone good on those? Okay. So product costs. Output represents one of the most important cost objects. So two types of output: products and services, right? So products and services is what a company is going to output, right? Because that's one of the two things. You're in business to provide a service or provide a good. It's usually one of the two. Products are goods produced by converting raw materials through the use of labor and direct manufacturing resources, such as the manufacturing plant, land, and machinery. So products, we know what products are. Furniture, it says here, a whole list of them, automobiles, computers, so on and so forth. We know what those are. So those are products. Service costs are tasks or activities performed for a customer or an activity performed using an organization's products or facilities. So the first one here, like medical care, teaching and stuff, so that's just an actual service we're providing. You go to the dentist, they clean your teeth, fix a cavity, root canal, whatever it might be, right? You go to get medical care, they take care of your broke arm or your treatment, whatever it is. They're giving you a service, right? The other one, using the organization's products or facilities, that's like if you rent a car. Okay, they're giving you a service so you can transport, have transportation, but you're also using their vehicle. Like if you go to Hertz or whatever these other rental enterprise stuff like that. So that's an example of a service that you're actually using the facility or a product, right? So it makes sense. Everyone knows the difference between a product or a service, right? The two different types of output. So service costs are different from products in many ways. First of all, services are intangible. What does intangible mean?
Touch or feel or see them.
Yeah, it lacks physical substance, right? Whereas something tangible is like this desk or a vehicle, computer, or something. So there's a physical substance. So there's a difference between intangible and tangible. Services are perishable. And I really, that to me, honestly, that doesn't really make sense. I mean, so however y'all want to infer that one. But Then the last one, services require direct contact between providers and buyers. So usually when you're providing a service, then you're gonna obviously have to go sell that service or provide that service, right? So if you get like say a plumbing call, then you actually have to go to that house or to wherever that facility is that has a plumbing issue and fix it, right? If you're cleaning someone's teeth, like if you're a dental hygienist, they actually have to come to your office to get the service. So there's going to be some face-to-face interaction. Whereas if you're providing a product or a good, that's not necessarily the case. It might be, but not necessarily. A lot of times, like Amazon, look, you never see anyone. You just get on there, click something, and if you have Prime, 2 days later, it's knocking on your door. So difference between service cost and product cost. Okay, so here's how it's used at Kicker. So pretty much, this Kicker right here, this scenario, I'll go ahead and just put it into my own words. Pretty much, they have they're marketing something. Let's just say I don't even know if what it is. It's trucks. So it's show trucks. So it's sound equipment. I'm sorry, it's sound equipment. That's what Kicker's using. Or what they're selling. So pretty much they have like these shows, right, annually, and they'll load up a bunch of their equipment on their trucks. Long story short, take it to a show or something and show off their stuff. Clear off the old last year's products at a great deal. Try to push the new products for a premium price, and just teach you a little bit about their goods and services. Pretty much trying to market something and just go reach a certain niche industry or a certain market. Pretty much. They're going to determine whether that's beneficial after all costs and revenues and expenses and everything's said and done. They sit down and analyze it, and if the costs are more than what you brought in, then obviously they're not going to do the show again. So that's pretty much, long story short, what they're talking about here at Kicker. They want to break down all the different costs of the fuel getting there, the cost of the truck, and the paying the people to go and to run the show, stuff like that. And they want to compare that against the revenues it brings in. And ultimately, like I said, if you made a gain, then they'll do it again next year, and if not, then the show will be canceled the following year. That's pretty much what it is. Just an example of how you need to keep track with it, because you don't want to continue having a show that's just causing you money or costing you money, right? Because the whole purpose of having that show is to push your product and try to expand your market and ultimately generate revenue. You don't want to just go out there and then lose money. So that's what they're talking about at Kicker. So providing cost information. Managerial accountants must decide what types of managerial accounting information to provide to managers. So what type of information to begin with, how to measure such information, and then ultimately who are they going to even give that information to. So those are the main decisions that the accountants must decide, the managerial accountants. Managers rely on managerial accounting information that's prepared, and they believe that's going to ultimately provide them with the best means of making a upper level decision based upon if they're going to bring in a new product, discontinue one, make a change to one, or whatever it might be, produce more of the same product with a break-even point. There's all kinds of different things we could be talking about here. There is a major exception, though. We talked about last class how the difference between financial accounting and managerial accounting, right? And what was the main difference between the two? Remember, managerial accounting is for internal users mostly, for like decisions based into the future, whereas financial accounting is for external users and it's based upon historic information, right? Well, there is one little exception for managerial accountants to where they actually have to abide by GAAP and US GAAP, which is generally accepted accounting principles, and that's relevant for external financial reporting, right? But they have to adhere to it for this one rule. And it's when providing outside parties with cost information about pretty much the cost of inventory, how it's going to be carried, the value of it on the balance sheet, and then how much the cost of goods sold for a period is. And for that, they have to follow GAAP. But besides that, there's pretty much not a framework they have to follow. So that's the one difference right there. So to calculate these two amounts, managerial accountants must subdivide cost into functional categories: production and period, right? And period is another word just for non-production, right? So product manufacturing costs, and this is dealing with determining product costs. These are costs both direct and indirect of producing a product in a manufacturing firm or of acquiring a product in a merchandising firm and preparing it for sale. So only costs in the production section of the value chain are included in product costs, right? And that makes sense because from that point in the production in the value chain, when it starts from the raw material until the point it becomes to an inventory ready to sell, that's all we want to include in inventories on the balance sheet, right? Because if we would include some of the selling expenses and stuff, it would distort it, and our cost would be too high on inventory, right? Which would affect our gross profit. So once again, only the cost in the production section entered in is included in product costs. And as we said here, product costs are inventoried, right? Because ultimately the product we produce is what we want to sell, and the companies sell out of their inventory, right? I'm sure you've heard when you go to a store and you maybe want to buy a pair of shoes, they might not have it on the size, and they have to go check their inventory or get in the system and check the inventory. So that's what we're talking about. That's their goods in inventory. Product costs initially are added to an inventory account and remain in inventory until it's sold, and at that point it's transferred from inventory to cost of goods sold. So at that point it's moved, your inventory balance is going to be reduced, cost of goods sold is going to increase by the same amount. That's your debit credit right there on the entry. So production costs eventually turn into what? Inventory. Inventory at the point of sale turns into what? Right. Because the inventory, easy way to remember, our inventory, we have a cost, right? We bought that inventory. So like let's just say, let's break it down real simple. Say I got something that cost me $10, right? I turn around and sell it to you for $20, right? So when I'm holding on to it, I know I got $10 worth of my inventory, right? So when I sell it to you, if I want to determine how much I made, I got to back out the $10 of my original cost to find out what my profit was. So that's pretty much all they're doing here. So when they carry it on inventory, all they want to know is they're just keeping track with how much they made. So they're saying, okay, this cost me $10. I'm selling it for $20. So cost of goods sold, I'm taking it out of inventory because it's been used or consumed. And now we're realizing that cost, so we're seeing how much it cost, and we're taking that from the gross profit or the gross sales, right? Make sense? Okay, product costs are going to be classified as direct materials, direct labor, and manufacturing overhead. So once again, product costs, direct materials, direct labor, and overhead. Why do you think these three product costs, or these three things make up product cost? Right. I mean, without any of those components right there, you can't even make a product, right? So if you I know it seems really difficult, but if you really just stop and think and just try to just break it down to the most simple thing, if we're trying to produce something, like let's just say me and the group right here collectively, we're going to try to build something, right? Let's just say we're gonna build a motorcycle or something. We'll build a motorcycle. If we don't have the materials to build it, we can't just grab stuff out of thin air and make it appear, right? So we can't do anything without materials. If we're not here to actually physically do the labor, nothing's going to happen to the materials. Even if they're sitting in the floor, it's not going to build itself. And then we have to have some type of overhead, some type of it. But there's got to be someone going over, looking at it. The overhead, our expense, you know what I mean? The labor going into the overhead, the building we're using. We can't just do it out in the middle of the road. So all these things are relevant to be able to even produce a product. So that's why these things make up that product cost. Make sense? So let's talk about direct materials a little bit. Obviously, these are materials that are part of the final product and can be directly traced to the goods being produced. Once again, if we're making furniture, lumber, or the fabrics, all that stuff, the screws, whatever it might be, all that's direct materials, right? Because we know we're buying all this hardware and lumber and stuff, and that's gonna all be directly put into our inventory or to our product, right? So that's direct materials. Materials can be directly charged to products because physical observation can be used to measure the quantity used by each product, like I just said. That's easy to see. You can stand there and watch something not being produced, and you can actually count and say, okay, well, there's that cost that, there's that cost that. You can actually itemize it and break it down to see what the whole collective cost of something would be. Materials that become part of a product usually are classified as direct materials. So once again, same song and dance here. So direct materials. Pretty easy. What are they? Just direct materials we need to build something, right? Pretty simple. Direct labor. It can be directly traced to the goods being produced. Once again, physical observation can be used to measure the amount of labor used to produce a product. So if we're watching an assembly line and we have these different workers out there, we can keep track with them clocking in and clocking out of how much labor it's actually taking to produce these units, right? So that's another thing that we can physically observe. Those employees who convert direct materials into a product are classified as direct labor. So the employees that we can tie directly to that process from point A of the raw materials to point B of the finished product. So all those employees that are involved in all those processes, we can just tie that into direct labor, right? Because it's specifically for that purpose. They're not involved with the accounting or legal or selling or marketing. They're specifically concerned. They come in from 8 to 5 and they work on producing their part of their product, right? So that's direct cost or direct labor. A company can also have indirect labor costs, and that's included in overhead and as an indirect cost rather than a direct cost, right? So the overhead, just anything extra. So if we need extra help to come in to try to just meet a certain mark or something or get it out at a certain time, anything extra that we have to bring in would be considered overhead, right? So all product costs other than direct materials and direct labor are considered manufacturing overhead, also known as factory burden, support, or indirect manufacturing costs, right? So, I mean, you could have like your direct cost and direct labor really down, and then your overhead just be out of control, and it could just completely just ruin it, So the overhead, the manufacturing overhead's key as well, and it's hard to control because a lot of it's unknown. It's hard to kind of control a big ship. You need so many different parts of it. It's kind of hard to determine, okay, what do we really need, what do we don't need, So the manufacturing overhead can really come into play. Costs are included as manufacturing overhead if they cannot be traced to the cost object of interest or the unit of product. So that's what the manufacturing overhead is. For example, right here, these are just some examples. Depreciation on plant, buildings, and equipment. So depreciation on that, we know this is a non-cash expense for companies, right? So depreciation, we capitalize assets because we're gonna derive a value from them. They're gonna produce for us in different periods moving forward. So when we talk about depreciation expense on these plant assets, that's gonna be one of the overheads because it's a cost of producing, for different periods. So that's gonna enter into it. Janitorial and maintenance labor. So obviously janitors, they're cleaning the whole building, but that's going to be, they spend time, they might clock it by time spent cleaning the sales department, time spent cleaning the factory, so maybe that's how they go about allocating like the janitorial work and stuff like that. Materials handling, power for plant utilities, stuff like that, So obviously computers in the accounting department and the legal department are going to draw power, as is the lights, but not nearly as much power as these big manufacturing machines are pulling to be able to produce the furniture or shoes or whatever it is we're producing. So that's a little bit about the manufacturing overhead there. It's just anything that you can't directly trace, but you have to allocate amongst it. Everyone good on the direct materials, direct labor, and the overhead? Is everyone okay on that? So now let's talk about calculating total product cost. So now we're going to start getting into a little bit of the calculations here, okay? So all that work just to get it to this. So hopefully it won't be as boring moving forward. So the total product cost equals the sum of direct materials, direct labor, and manufacturing overhead, right? So once again, total product cost is the sum of direct materials, direct labor, and manufacturing overhead. So we can see here the formula right below that. Total product cost is direct materials, direct labor, manufacturing overhead. Pretty simple, right? So the unit product cost equals the total product cost divided by the number of units produced, right? Which makes sense. So if we know what the total product cost is to create all the products, right? The product that we have. So if we want to determine how much one unit of that costs, we take the total product, the total price of all the products, and then divide that by the number of units produced, and that's going to give us the unit price or the unit cost. Make sense to everybody? So what is total product cost again?
The amount that's accumulated from direct materials, direct labor, and overhead costs.
Right. And then define the unit cost. How do we find that? I know it's right here. I like repeating it. How do we find the unit cost after we find the total product cost?
Take that number and divide it by the number of units produced.
Right, and that'll give us each unit cost. So product costs are essential to management control and decision making. Managers use product costs to create budgets and analyses. Product costs within manufacturing can then be contrasted with period costs incurred outside of manufacturing. So the total product cost is key. So obviously we can create these budgets and analyses based upon total product cost, because obviously if we know how much it costs to produce a total product, then we can infer what the break-even point will be, whether it's going to be profitable, whether we should undergo the project from the beginning or not. So it's really helpful in determining whether it's going to be productive or if it's going to be worthwhile. It's also good, like it said, with period costs. So you can help control period costs as well by having your product cost under control. And we're going to start getting into examples on the next slide here and start actually applying these formulas with actual problems so we can see. So everyone ready to get into the problem? So how to calculate product cost in total and per unit. So same thing we just went over. So Blue Denim Company makes blue jeans, okay? Now last week, direct materials, the denim, the threads, the zippers, and rivets, costed them $48,000, and it was put into production, okay? Direct labor of $30,000, which was comprised of 50 workers working 40 hours a week at $15 per hour. That was also going to be incurred during the week. Manufacturing overhead equaled $72,000, and by the end of the week, Blue Denim had manufactured 30,000 pairs of jeans. Okay, so with that information given, try to go ahead and calculate the total product cost for last week. And when someone thinks that they have the answer, let me know what you end up with. Anyone think they got it? Y'all need another minute or two? I'll slow down if y'all. We'll give them just another second, then we'll get into it. And right now, we're only working on the first one, just the total product cost. Y'all ready for the answer? I know someone says they have it now. Are you all okay? Who wants to? Do you all think you all have it? Who?
$150,000.
Right. And how'd you get that?
Adding up to 48,000, 30,000, 72,000.
Right, because that's exactly what total product cost is, right? Everything was given in the problem. It's just that's why you have to know these formulas. I think there's about 7 or 8 for this chapter. So really, if you know the terminology and you know the formulas, and then just practice the problems, you shouldn't have any problems with it. It's just knowing what to look for. So everything there was given. It's just basic math there. So 150,000 is right. So you literally just plug the given into this to get the total product cost. So good job there. Now what about, can you all calculate how much one pair of jeans that was produced last week would cost? You already got that as well? So how much would that be? $5. And how'd you get that?
Divided by 30,000.
Right, because that's the amount of pairs they did it by the total cost. So that makes sense. Simple enough, right? So yeah, that one wasn't bad. Everything was given right there. So here's the math, the layout of it. So obviously to get total product cost, we just add up the direct materials, direct labor, manufacturing overhead. That'll give us total product cost. Then once again, per unit product cost is total product cost divided by the units produced. That'll give you $5 per unit. Simple enough, right? So just know the terminology and just know the formulas, and then from there you should be able to work through any of the problems. Most of them, because this is a hard class by nature. I mean, accounting is just hard by nature, anyways. So now let's talk about prime and conversion costs. So product costs of direct materials, direct labor, and manufacturing overhead, they can be grouped into prime cost and conversion cost. Prime cost is the sum of direct materials costs and direct labor costs. So pretty much you can see the formula here once again. Prime cost, right here. Prime cost equals direct materials plus direct labor. Why do you think it might be called prime cost? And I'm just making this up. Why do you all think that might be called prime cost? Just between the two elements that we're adding up there.
It's the direct thing that causes the product to be.
Right. Because you have to have direct materials and direct labor, so that's the primary focus right there. So that's how I infer it as the prime cost, because it just helps me remember. Prime cost. Though it's the most critical things, it's direct materials, direct labor. So that's the primary part of it. That's how I remember prime cost: direct materials plus direct labor. Okay. Conversion cost is the sum of direct labor cost and manufacturing overhead costs. So once again, that's this bottom one here. Conversion cost is direct labor plus manufacturing overhead. And once again, why do you think they could name this conversion cost? You have to have the direct labor and manufacturing overhead to be able to convert it from a raw material to a product, right? So that's the conversion cost. That's my understanding. It helps me remember these two different formulas right here between the prime cost, conversion cost. So once again, prime cost, direct materials, direct labor. That's primarily, you have to have that, right? Then the conversion, what does it take to convert that raw material to an actual product or a good? Well, then we're going to have direct labor and manufacturing overhead to take those raw materials, right, or direct materials, to convert it into a good. Makes sense? Everyone good on the prime cost and conversion cost? Okay, let's look at another example here. So Blue Denim Company makes blue jeans. Last week, direct materials, denim, threads, zippers, once again, costed $48,000. Were put into production. Direct labor of $30,000. Same thing. Manufacturing overhead equals $72,000. By the end of the week, Blue Denim had manufactured 30,000 pairs of jeans. Okay. And this one, sorry, I don't have my slide point put up, so the first solution is given. The first thing, calculate total prime cost for last week. If y'all want to try it on your own, I know it's given here, so we can just look at it. We don't need to, try. We can see it. So pretty much total prime cost. Remember, what's prime cost? Direct materials, direct labors, right? Once again, it was given, right? So $78,000 is total prime cost. How do you think you would calculate the per unit prime cost?
You would take that over the amount of things produced.
Right. Same thing we did with the actual unit cost of overall total product cost, unit per cost. It's just now we're more specific. We're talking about the actual total prime cost, right? And here we want to do the per unit prime cost. So same thing, just total prime cost over units produced. So same thing. What about, can you all calculate the total conversion cost for last week? Do y'all know?
102,000.
102,000? I haven't looked at it yet, but let's just see. 102,000, yep. And once again, that's direct labor plus manufacturing overhead, right? So the same thing, we just went over to formulas. We're just using the example and plugging the numbers in. Once again, the per unit conversion cost, 102, total cost, divided by your units produced, total unit cost, right? Pretty straightforward. Anyone have any issues with that, or easy enough? Okay. Now just remember that the prime cost and conversion cost do not equal total product cost, right? Because we have the direct labor. Yeah, direct labor is part of both of them. So just remember, those two together do not equal total product cost. It's just, they just use that as a different means of breaking down cost into a different, like a deeper level. So everyone good on prime cost, conversion cost, and that stuff? Okay. So let's talk a little bit about period cost. So cost of production are assets that are carried into inventories until the goods are sold, right? So those are going to be inventoried, right? The production costs. So now period costs are going to be the other costs, right? That are not going to be carried into inventory. So period costs are all costs that are not product costs. So all areas of the value chain except for production. So what do we mean? We got selling expenses, general administrative, and stuff like that, right? So this is stuff from the point we've already produced our good to sell. Now, these are period costs beyond that, because the first cost is producing our good to sell, and then from that point, it's going to be a period cost. So some examples of period costs: office supplies, research and development activities, CEO salary, and advertising. All period costs, okay? The level of period costs can be significant, and controlling them may bring greater cost savings than the same effort exercised in controlling production costs. So, do you all recall from principles the difference between a single-step income statement and a multi-step income statement? Pretty much single step, they're bulking all revenues and gains into one category on the top part. Then they're subtracting all expenses and losses. That's single step. Multiple step, they break it down into components so you can see different aspects of a company, okay? And that's what we're concerned on this with period costs. So I'm telling you this because it'll show you where the period costs are on the income statement. So on a multi-step, we break it down. We start with gross sales, right? Gross revenues. Then from there, we back out what? Remember, if we sell something, it would used to be inventory. From gross revenue, after we sell it, inventory becomes what?
Cost of goods sold.
Right, so top of the income statement on multi-step, we have cost of goods sold, gross revenues minus your cost of goods sold, and what's that going to give us? That's our first line item on the multi-step, because that's one of the first step it's going to show us. What's that tell management or the external users? Your gross sales minus your cost of goods sold is going to give you your gross profit, right? Which is just the difference between your revenues and your gross profit, right? So that tells us right there how much we make based solely off selling our product or service, right? That's our first item on the multi-step. That's why we're breaking it down instead of just bunching all the revenues and expenses together, because that doesn't really tell you much about the performance of a company. But on the multi-step, if we start with the gross revenues and back out cost of goods sold, we can see the gross profit. Okay, they made this much money just from selling their products. Then from that point, we want to back out selling expenses and general administrative expenses below the gross profit, right? What's that going to tell us? And this is the period cost we're talking about. We back out, after we find gross profit, back out general administrative and selling expenses. What line item, what's that going to tell us? What's that line item called? Think about it. After we go through the selling expenses, attorney fees, and all that other stuff, marketing, general administrative,
Net
that's operating income. Okay? So let's start at the top. We have our gross revenues, right? Back out from there. We back out what? Cost of goods sold. That gives us what? Gross profit. What's that? What's gross profit tell us about a company? How much money they make what?
Sales.
From selling their goods or service, right? Without it returning anything else. That'll give us our gross profit. Then from there we back out what? Period costs, which are right.
Operating.
Right. Operating expenses is what they are, but they're categorized for accounting purposes. Selling and general and administrative is what they're marketed as, pretty much. And then once we back out the operating expenses, general administrative, selling gives us operating income, and that tells the users and management, okay, we made this much off of selling our product for gross profit. Then we back out all the other stuff in order to bring it to market. Operating expenses gives us our operating income, right? And then from there we get the gains, losses, and then we have income before taxes, then income tax expense, and so on and so forth. But do you see what's so critical to make sure your product costs are intact, so your cost of goods sold is at the very top, right? Because that's going to determine all the money you have to cover all your operating expenses. So if you're overpricing something, or if you're putting costs that are unnecessary into it, your gross profit's going to be smaller. And you're going to have less to cover over your operating expenses, right? Because think once you get to operating income, you still have gains and losses, which is peripheral, right? So meaning it's not like revenues, like for holding securities that are marked to market or stuff of that sort, right? then you still have to have your income tax expense. So see, that's so critical. There's still so many other costs that a company has to incur because we're in business to make money, right? We want that cash, pay me, right? So we got to get our costs right because that's going to base what we can sell it for, but determine gross profit, which covers period costs. So it makes sense, right? That's why this is so important. Once again, period costs, salaries, advertising, stuff like that. Level of period costs, once again, it's just as important. You have to have it under control, but you have to make sure the first part's under control to be able to have enough money to be able to satisfy the expenses to get through the operating income. Okay, period costs typically are expensed in the period in which they incur, or which they are incurred. So that makes sense. Salary expenses, the period they incur, that's when we're going to recognize it as expense, right? If we have marketing or advertising or selling expenses, we're going to recognize it in the period that it's incurred, right? So if we're marketing something for the month of January, we're going to expense it in the month of January because we're trying to get sales based upon that marketing effort. So we're going to match those revenues based upon that marketing effort against the expense of being able to produce that marketing advertisement. So does it make sense? So the period that it's incurred, that's why they're called period costs. If a period cost is expected to provide an economic benefit, meaning revenues, so if something's going to produce revenues, i.e. like a building or a vehicle, right, then we need to capitalize that. So what do I mean by capitalize an asset? So in accounting, we can either say when we purchase something, right, we're either going to say, okay, we're going to capitalize this or expense it. So if we expense it, we know what income statement. Obviously, it hits your income statement. I was going to say what financial statement. If we expense something, it's going to be an expense, right? Because what's on the income statement? Revenues, expenses, gains, losses, right? So if we expense something, it's going to be a period cost. We're not like if we're buying something, like say I don't know, something that's not going to last for a longer period, whatever it might be. Say we're buying like water for the office or something. That's going to be period cost because we're not going to get the benefit out of it once it's consumed, whenever it's consumed a short period of time. But like say, if we buy a car, like a company vehicle, right? We're not gonna that car is gonna. We hope it's gonna last longer than a year, right? So when I say capitalize that, that means we're gonna carry it on the balance sheet as an asset. So capitalization means it's gonna be on the balance sheet, right? So when I say we're gonna capitalize something, we're actually gonna account for it on the balance sheet. It's recognized on the balance sheet, and then. How do we match the expenses off something we capitalize in periods in the future? Through a systematic allocation of depreciation, right? Because remember, depreciation is a non-cash expense, okay? What's that mean? Why is depreciation a non-cash expense?
Because it's not something you necessarily have to pay cash for.
Right, because you incurred the cost up front when you purchased the asset that you capitalized, right? So the money's already went out. That's an investing cash flow on the statement of cash flows. Money's already went out for the investment of your plant assets. But we know it's going to produce money over time. So if we would expense that asset in that period, it would distort income for that period and all future periods that asset's producing revenue, right? Because remember, we want to match. That's a matching concept. We want to match revenues and expenses in the period it's incurred to be able to truly derive or ascertain what the actual performance of a company is for a period of time, right? So that's all that is. When I say expense, we're hitting the P&L. We're expensing it in the period incurred. If something we buy, like a truck or a building, is going to produce money for the future, we capitalize it and carry it on a balance sheet as an asset. And then over time, we reduce that asset through depreciation, and depreciation that hits your income statement. And if we think it's going to give us, like for 5 years, for example, then we depreciate it, whatever cost less salvage, and most times it's straight line, divide it by the useful life, and that's what enters into the determination of your depreciation expense. But we won't get into all that, but that's what we're talking about here. If the period costs are going to be a benefit to the future period, capitalize it and then systematically depreciate it into the P&L. Make sense? So this is just a little diagram on period costs. So pretty much costs, we have two different types, right? Product and period. What's the difference between the two again? Product is what?
Is what goes directly into the product.
To product, right? So what are product costs? What's total product cost again?
Direct labor, direct materials, and overhead.
Right. So that's your product cost. Now period costs. What are period costs again?
Selling expenses.
right? Think about the value chain. Remember, product cost is everything to get it up to the product from the raw material up to an inventoriable state, right? Period cost is everything beyond that. So you're selling, your accounting, legal fees, and all that stuff. So that's our period cost. So let's go back over here to the product side. So on the balance sheet, inventory, right? So after the product is after we produce the product or manufacture the product, then we have to carry it, right, on in our inventory. It's an asset to the company. So assets are carried on what financial statement? Balance sheet, right? Assets are on balance sheets. So once the product's produced, what the product cost is produced, it's carried as an asset on the balance sheet as inventory. Then when it's sold, what happens to it? Remember, the inventory turns into what? Which is on what financial statement? Right. Awesome. Revenue, gross sales minus cost of goods sold gives us what? Gross profit, right? Which means what? That's what the money we get from what? From our gross sales, and it's only the cost incurred within that product, nothing else. Now, period cost again. If it's a period cost and it's not going to benefit the future periods, we just expense it in the period occurred, right? So we're just going to go straight down here and hit the income statement. If it's going to benefit future periods, we have to what? Capitalize it. So if we capitalize it, what financial statement is going to hit? Balance sheet, because assets are on the balance sheet, right? Remember that good old accounting equation? Assets equals liability plus owner's equity. That's your balance sheet. You have assets, liabilities, and owner's equity. Okay, that's the strength of a company at a point in time. The overall strength at a given point in time. That's the position, the financial position of a company. The income statement is a measuring tool. You're just measuring the performance of a company for a period of time. That's why you're doing the revenues and expenses, and then your net income closes to retained earnings, which is the equity component. So that's how they operate. So the balance sheet, just a snapshot of the assets, liabilities, and the equities, or rights to those assets after the liabilities have been satisfied. Income statement, we're looking at the performance. How well do they manage these assets and liabilities and produce revenues and ultimately try to grow the company through equities or net incomes? Make sense? I know that's a lot. Everyone good? Y'all were like, man, I thought I was done with accounting. I didn't think I was ever going to see these financial statements again. But unfortunately, maybe when you get to this class of your management, you won't see it too much more. But unfortunately for this class, we have to pull stuff off. And this is like the why. So financial accounting is what happened because it's historical, right? This is why it's happening. Okay, so this is how we're getting those numbers and where they punch in on the financial statements. Everyone good on the period cost? So what's period cost again? In terms of the value chain, where does the period cost start?
Once it's produced.
Right, after all goods have been produced at the inventory point. So from that point, from pretty much the period cost is what it takes to sell that inventory, right? Through legal, accounting, marketing, advertising, whatever it might be, right? So those are going to be your period costs. So let's talk about selling costs. Those costs necessary to market, distribute, service a product or service or selling costs. Obviously, we know that anything that goes in to trying to sell something. So order getting, examples, sales personnel salaries and commissions for advertising. So like if we have a sales team, like a company I used to work for, we sold big, huge, heavy duty truck parts, right? We had an external sales force that actually had like a fleet of salesmen. Where they had their trucks and they had their established accounts, and they'd go out and visit them, make sure they had all their supplies and everything. So all their salaries and their commissions that we paid them was going to be charged as a selling expense, right? Because they're in the business of selling our goods, right? So that would be one of the components of a selling cost. Order filling, let's say that would be like warehousing, shipping, customer service. That would be a selling cost, right? So if we're holding something in a warehouse, usually, it's been sold at that point a lot of times, or it's just being held there. Because if it's being held in a warehouse, ultimately we're holding it there until it's sold, right? So that's going to be a selling cost right there. Customer service, obviously, that's a selling cost because we're servicing something we've sold, right? Shipping, so let's talk about this. Shipping, okay? Like shipping out, like if we ship something out, that's a selling cost, right? Freight in to receive something, if it's FOB destination, then that's going to be freight in, right? Or FOB shipping point, meaning that the time it ships from the seller, like if we bought merchandise from a company and the minute it left their docks, FOB shipping point, it's our inventory. But the shipping cost coming to us is an inventoriable cost because that's a cost included to bring that inventory to a sellable condition, okay? Selling expenses here, shipping expenses out is a selling expense because that's a cost incurred to be able to sell the product once we have it in an inventoriable state. Does that make sense? That's why selling or shipping expenses, only shipping out to sell is entered into the selling cost. Make sense? Anyone lost here? So selling cost, pretty much anything that enters into determination of getting a product sold, right? Anything, warehousing, shipping, like shipping costs going out, okay? Stuff of that sort. So next, administrative costs. These include research, development, general administration of the organization, and cannot be assigned to either selling or production, right? So by default, this is the default category. If we can't match it to the producing our good or selling our good, then by default, it's going to fall into the administrative cost. So general and administrative, that's the default category. So general administration ensures that the various activities of the organization are integrated so that the overall mission of the firm is realized, right? Which makes sense, because what enters into the administrative cost? The C-suite, right? Meaning chief financial officer, chief operating officer, the C-suite, all the chiefs, right? All those salaries are going to be administrative costs. So obviously, what are they there for? To make the hard decisions, to keep the company in line, to go to board meetings, right? So that's why the overall mission of the firm is going to be realized through these general administrative costs, right? So what are the three different cost categories for a manufacturing firm as far as what we've broken them down to, as far as how we can group costs through the three different cost categories?
Manufacturing,
Or-
selling,
You're on the right term. The manufacturing, remember, manufacturing is a component of what type of cost? The manufacturing, like remember, direct labor, direct materials, overhead is product cost, right? We have the product cost, right, which enter into inventory and then cost of goods sold, right? And I'm getting back to those components of the multi-step. The next selling category we group cost in is what? Right, which would be like and then those are broken into two different parts, which
So
are
like
what?
the prime and conversion cost or not?
No, we're talking about the three main components. First one is your production costs, right? Your total product cost, which is your production cost. So you're right, the production cost. Sorry about that. So that's going to be all the cost included to get the inventory in the sellable state, right? So that's our first thing, which is ultimately going to be the cost on the income statement. It's going to be reflected as the cost of goods sold, right? We've established that, right? You follow me? From producing the good, from the raw material, then we have an inventory, right? It's going to be inventoried after the production cost is inventoried. Then when we sell it, it's cost of goods sold. So there's one, production cost. The next one, like you said, period cost, but there's two components of period cost. Remember, there's a default category in the first one. If we're not producing something, after it's produced, it's going to be inventory. Then we want to do what with it? Right, so we have selling costs, right? So we have production cost, which is going to enter into the P&L as cost of goods sold. We have selling costs, right, which is a period cost, and then by default we have general and administrative. Just important. The same thing. If you think of that multi-step, gross revenues, cost of goods sold, gross profit. Cost of goods sold is your product costs, right? Then from there we have, to get to our operating income, we just back out the period costs, selling, general, and administrative. Make sense? So that's what administrative costs are. And some more examples: salaries, legal fees, printing, annual report, general accounting, stuff of that sort. Research and development costs are the costs associated with designing and developing new products and must be expensed in the period incurred. So anything research and development wise. So what exactly is the activity of research development?
Like finding better ways to like effectively use your materials or getting your materials to a certain place. Anything to cut costs.
Right.
While still producing a good product.
Right. So pretty much research and development, like you said, anything of researching like a new way or a new means of doing something more effectively or more efficiently, right? And then trying to develop that to get it to a certain point. So what we're saying, so anything that would relate to that, so like if we're researching something, like maybe we want to use a different type of steel if we're building bridges, okay? There's a new type of steel out, and we're going to research it and you know and do the R&D and stuff like that. All what they're saying is those costs should be expensed as incurred as period cost, right? Don't include those into inventory and manufacturer overhead and stuff like that. Make sense? Because we don't know if it's going to be successful or not, right? So to include that, even if it was successful, to include that into the actual cost, that's not going to be a true cost of a product because we're researching and developing it, right? So we want to expense that, right? Make sense? Okay. Now once we have a new process figured out and we get to a certain point, and then we start production, that's when you enter it into productive costs. Make sense? So anything aimed at just finding new discoveries and trying to come about a process as research and development, expense it as a period cost as incurred. Okay? Y'all okay? Y'all need a break, or y'all want to just get through this? I say we can wrap it up probably by 6 o'clock if we stay on it, or y'all want to break. It's up to you. I don't care either way.
Good to go.
Good to go? All right, cool. That's what I was hoping to hear. I'm good to go too. So there might be times where I'll be like, man, I need a break. Okay. So y'all are good to go. Okay. So direct and indirect period costs. So distinguishing between direct period cost and indirect period costs. Indirect labor is included in overhead. Service companies distinguishing between direct period costs and indirect period costs. These costs do not affect the calculation of inventories or cost of goods sold for service companies. Correct classification affects decisions, planning, control activities for managers. Okay, let's just go to this next slide here. There's not really nothing relevant on that. So example, restaurant, direct period costs. Once again, the salary, we know that's a direct period cost, and we can directly tie that into the chef, right? Because it's directly tied to him. Indirect period cost, disposable napkins, so stuff of that sort, really. Everyone good on that one? Okay, data analytics. Let's just see how this works out here. I'm not pretty sure you are going to laugh at me. I just went to go take a drink of water with that on. I would have went everywhere, wouldn't it? Tell you, I feel like I'm teaching welding up here, you know. Tell you. So increasingly, accountants use data analytics tools to help define, access, and utilize industry benchmark data for evaluating their own performance against that of other key competitors and industry leaders. Specifically, benchmarking allows managerial accountants to help management better understand how the organization's accounting performance metrics, ratios, results compared to the performance of similar companies, right? So pretty much by benchmarking, we've all heard what benchmarking is. You know, we have firms in the same industry, like I said, and if you can look at and analyze trends across, you know, the same industry, and you can see maybe, okay, well, you know, their gross profit's a lot higher. Why is that? And then try to decipher why that is. Okay. So they say here, similar companies to operate in the same industry, comparable size, face common risks such as regulatory scrutiny, and etc. So that's why you want to kind of stay within the same industry, because you have the same forces coming at you, right? You don't really want to compare a financial industry with like a mechanics industry or a car industry. Okay, there's no correlation between the two. So pretty much that's what they're saying here. With the rapid growth of data analytics, managerial accountants can access the larger quantities of benchmarking data from a much wider set of data sources, both domestic and multinational organizations, at a considerably lower investment of time and money. So obviously, as a result of that, the trends and patterns and how the organization's performance compares to that of the other important benchmarked organizations can become more quickly and accurately detected, and most importantly, the associated management decisions can be made to improve the performance, to stay ahead of or catch up to the competition. So we obviously, you've always heard, I'm sure y'all have had the entrepreneur classes, you always want to be concerned with the customer, right? That's key, customer is key, but you also want to know what's going on within your industry and your competitors. So that's pretty much all they're using here is just benchmarks, different ratios of cost that has been compared. And by doing so, you can kind of see where you should be at, right? Because there's going to be obviously those companies that are doing well, that's who you're going to want to benchmark against to see, and then try to figure out why it is that you're behind or ahead or right there in the median range. So pretty much that's all the data analytics, what we're talking about here is just being able to use it as a tool. So right here it says, for example, Twitter can use data analytics to gauge how its expenses as a relatively young and publicly traded technology company compared to like Facebook and LinkedIn. So pretty much they can look how much like Facebook and LinkedIn is using on R&D, and then look at themselves and decide like, man, why is there so much higher or lower, and see what's going on. So pretty much data analytics, just looking at the data that the different companies produce and just benchmarking it across relevant industries. I'm sure that's a concept everyone's heard of, benchmarking and so on and so forth. Okay, now let's talk about preparing income statements, the cost of goods manufactured. So the cost of goods manufactured represents the total product cost of goods completed during the current period and transferred to finished goods inventory. So the cost of direct materials used in production can be derived using the following formula. So once again, this bottom formula here, beginning inventory of materials plus the purchases minus the direct materials used in production will give us the ending inventory of materials, okay? So once again, the cost of direct materials used in production is found by taking beginning inventory of materials, add in your purchases for the period, and then back out the direct materials used in production, and that'll give us the ending inventory of materials. The direct materials are then used to calculate the cost of goods manufactured. So this is a two-step process. Direct materials plus direct labor plus manufacturing overhead costs plus beginning work in process inventory minus ending work in process inventory equals cost of goods manufactured. And I know that sounds like a lot, but there's an example that always helps show it. So just think about that for a minute. So once again, we take this two-step process. First, we find the cost of goods manufactured with this formula. Then the ending inventory of materials is then used right here into this formula. Okay, so now let's get into a little. We got one more step here, then we'll get into the problem. The primary use of calculating the direct materials used in production is to serve as the first number in calculating the cost of goods manufactured. So once again, it's a two-step process. You have to find the first one to be able to find the second one. Direct materials used in production also shows managers the difference between the amount of materials purchased and the amount of materials used in manufacturing for the period. So it helps us know, okay, man, we bought too much, or we didn't buy enough. So this is a good checkpoint here to see why there might be variances as opposed to the amount purchased and the amount consumed. Okay. So example 2.3, how to calculate the direct materials used in production. So Blue Denim Company makes blue jeans, right? Same company here. On May 1st, Blue Denim had $68,000 of materials in inventory. During the month, May Blue Denim purchased $210,000 worth of materials, and on May 31st, materials inventory equaled $22,000. So can you all calculate the cost of direct materials used in production for the month of May? Once again, there's the formula at the bottom. Just if you want to glance at it one more time, and then I'll go back to the problem. Okay, here's the problem again. Anyone think they have it? Okay, what'd you get?
$256,000.
Mm-hmm. And you found that by right here, obviously. Just remember, Direct materials used in production. Think about it. We start with the beginning amount on hand, right? So materials inventory on May 1 was $68,000. So if we already have that much in hand, right? So we already know we have $68,000 worth of materials. From there, we add our purchases of $210,000, right? So if we have the beginning materials and then our purchases, then we know the total amount of materials that we have on hand before we start producing anything, right? So that's why we want to know what we had from the beginning and purchases. And then that amount is what? $278,000, right? So then if we have the total amount that we have on hand to be able to produce with, if we back out the ending materials, the difference between it is going to be what we consumed or produced. Does that make sense? So if we have our starting amount, then add on how much more we bought. We know how much total we have, and then obviously if we back out what's left over, the difference between the two is what we produced or used. That makes sense? Okay. And a lot of this ties in with, if y'all recall, I don't know if y'all remember the cost of goods sold. Did y'all get into the cost of goods sold formula and the principles? I don't know if I think that might be an intermediate thing. I don't recall, but this relates a lot to the cost of goods sold, and we're actually going to get into that anyways. But if y'all did have that, I don't recall if it was the principles concept or intermediate. But that's the direct materials used. Remember, the beginning amount plus what you purchased, back out what's ending at the end, and then that'll give you the in between, what we need. So work in process. Once the direct materials are calculated, the direct labor and manufacturing overhead for the period are added to get the total manufacturing cost for the period. So the second type of inventory, which is work in process, right, is the cost of partially completed goods that are still on the factory floor at the end of a time period. So we have ending inventory, right, just our actual ending inventory amount, right, which is completed inventory that's already completely been processed, right? And then the other part of the inventory is going to be the work in process. And once again, that's the stuff that, just at the middle of the production period or whatever, the month ended. So in that period, whatever's on the floor on that line, from the raw materials that's already been started, that's not all the way produced to there, that's what the work in process is going to be. And that's going to be considered inventory work in process. So we have just completed inventory that's ready, conditions that's readily available for sale. And then we have the inventory work in process, which is still on the production floor, that's just maybe halfway or a third of the way produced. Make sense? So the work in process units are units that have been started but are not finished. Obviously, they have some value, but not as much value as when they are completed. And there they are beginning and ending inventories of work in process. We must adjust the total manufacturing cost for the time period for the inventories of work in process. That makes sense, obviously, because we have to know what cost we have that's tied up in that work in process inventory, right? So we have to account for that as well. Now, after this adjustment, we will have the total cost of the goods that were completed and transferred from work in process inventory to finished goods inventory during the current time period, which is the cost of goods manufactured. Okay, so just follow with me. I know this is adding on to the thing we just had, but there's another example coming up. Okay, and this one's a little different. I'm actually going to show you this one after we read it, and we're going to flip back and forth and work it because it's that two-step process. So we'll sit down and work through it because you'll see something like this on your homework and probably on your quiz as well. So let's just read through it here. It says how to calculate cost of goods manufactured, right? So Blue Denim Company makes blue jeans. During the month of May, Blue Denim purchased $210,000 worth of materials and incurred direct labor cost of $135,000 and manufacturing overhead of $150,000. On May 31st, materials inventory equaled $22,000. So inventory information is as follows. And this is something that I want you all to get used to seeing on this question here, how we have like items here, like materials, work in process, and then you'll have two different dates given to you with amounts, okay? The accounting questions love asking you questions in this format. So just get used to seeing like data and then a chart with some numbers and stuff, okay? It can look overwhelming and really confusing just from like the bird's eye view, but once you get into them, if you understand the stuff that's going on, it's really not that bad. Here I go again. So we'll take this information here and then let's see what it's asking us here. It wants us to calculate the goods manufactured for the month of July, okay? So I just want to work through this one with you all instead of having you all try to work through it on your own. So the first thing we want to do is find the direct materials used in production, right? Does that sound familiar of what we just did? We just found that, right? So how do we find the direct materials used in production again? The answer is 256,000. So let's go back to this question. How did they get that 256,000 for direct materials used in production? Because remember, that's our starting point for the problem that we're trying to solve. So we have to be able to find that number to be able to even start it. So once again, we're trying to figure out the direct materials used in production. So how do we derive $256,000 from this data right here? We just did it in the last problem.
Take your purchase inventory materials plus your beginning materials, and then subtract out the ending materials that you get here.
Exactly. So right here, once again, everything's given, right? It's just a different format. Like I said, some of it's up here and just in the language up here, the verbiage, and the others down here in the chart. So once again, direct materials used in production, that's what we're using, right? Direct materials used in production, the 256, we find that, that's our starting point for this. Remember, beginning of the period materials, which is given May 1st, because we're concerned with the month of May. So that's the $68,000, right? So that's our starting point. So we have to know what we have to start with. And then it says right here, we purchased 210,000 materials, right? We're dealing with materials here, materials in production. So the beginning is May 1st, 68,000. Then we want to add our purchases to that, right? So that gives us our total amount that we have to produce, right? And remember, if you recall, then we want to back out the ending amount. And the difference between the two will give us direct materials used in production, right? Because think about it, if we started with 68,000, we bought 210,000, right? So that's going to give us our total amount that we have to produce. At the end, we only have 22,000 left. So if we want to subtract that out, like I said, the difference is what we consumed. And I know it might just click, like it might be at the end of the semester, it might be next week, might be tonight when you're working on it, or whatever. But it will click and make sense. I know it sounds kind of odd trying to think of it, but if you really just sit down and think of it, it really makes sense. So that's how we start. Remember, beginning materials plus purchases, mining ending materials, and that's gonna give us the 256,000 of direct materials used in production, right? So from that point, what else do we have to do for the total manufacturing cost? We've got the direct materials, right? What's the other components of the formula that we need?
Direct labor and overhead costs.
Right. See how this builds upon the content? How everything, all that boring terminology in the beginning that I was boring you all with, how it's all relevant here. So once again, the total manufacturing cost is what? Direct labor, direct materials, direct labor, and then the manufacturing overhead, right? And that's total product cost, right? But for here, we have to find direct materials because it wasn't given. Sometimes it might be given. Sometimes we have to find it. It's unknown in this case. We have to solve for it. But we can solve for direct materials using production, right? How is it again? Beginning inventory, beginning materials on hand plus purchases minus ending gives us the direct materials used in production. Then remember that's the starting point. That's one of the three components: direct materials, direct labor, then the overhead. That gives us total product cost. So we've got that, right? And the other stuff was given too: 135, 150. Incurred direct labor cost of 135. Manufacturing overhead of 150. So it was all given. We just had to find that direct materials used, right? And then from that point, remember that it told us on that slide up there, this is our starting point. From here, this middle point, we have to deal with the work in process. Remember, we were talking about the work in process, because we have two sets of inventory. Inventory that goods are readily available for sale. Then we have inventory work in process that's still on the manufacturing floor, right? So now we have to account for those, because now we just have total product costs, but we have to account for what was already in there. So same thing here. Just watch. It's kind of the same thing we did to start to find direct materials used. We want to add beginning work in process. I know it's not the same, but we want to add beginning work in process and then subtract ending work in process. Okay? And that's going to give us the difference between the two of what we need. And then that's going to leave us with the cost of goods manufactured for a period. Does this make sense to everybody? Let's just look through it one more time. How do we get the direct materials used in production? If it's not given.
We take our beginning materials plus our purchases minus our ending materials.
Correct. From there, what are the components of total product cost? We have to get the total product cost. We've already got one of them, direct materials used in production. What's the other two components of that?
Manufacturing overhead.
Right. So then that's going to give us total product cost, right? From there, we're not done yet because we want to know the cost of goods manufactured. But remember, there's already stuff. There's work in process we have to account for. How do we decipher out the amount we need from that?
Beginning and then
Right. But what do we do? Do we add?
subtract the end.
Right. We add the beginning to the total manufacturing cost, right? For that we got from the three components of total manufacturing cost. Then from there we add beginning work in process, back out ending work in process, and that'll give us the cost of goods manufactured. Not too bad, right? It's a lot though when you sit down and read a question and it's throwing all that out there. You rarely have to compartmentalize your thought process, whether you write it down, okay, well this is what I need to find, this is unknown. So just really stop and think through it and just break it down to as simple as you can. Think about the components of total product cost. If only two of them are given, you have to find one. How do you find it? Beginning materials plus purchases, subtract out ending. There you have it. Okay? When you add all those up to the total manufacturing, there's still one more thing. If you have work in process, some questions might say there was no beginning or ending inventory and work in process, which I love those because it just takes a whole step out. But if there is work in process, it's very simple. Add beginning, back out ending. Right? Just one more step. Not bad. Everyone good on this? Let's talk about cost of goods sold. So once again, remember, this is the only rule, the only little caveat to managerial accounting. You can just run wild within the company besides this rule, right? No, I'm joking. So this you're constrained to GAAP for this rule for cost of goods sold. Remember, to meet external reporting requirements, cost must be classified into three categories. Here's our three categories we talked about: production, selling, administration. Right? If we're looking at a multi-step income statement, you're going to see that. Production costs are going to be shown where? How do we see what production costs are for the period on the income statement? That's going to be that we actually incurred, that we consumed out of the inventory. Cost of goods sold, yeah. So our productive costs, the production costs that transfer into the income statement. Because remember, production costs are inventoried. When inventories are sold, they're entered in as cost of goods sold. The selling expenses, remember, that's on the value chain after we have the production up to that point of the materials. Beyond that, everything's selling it. Selling expenses, legal, accounting, everything. Bookkeepers, whatever it might be. Utilities, you name it. That's the selling or whatever that's tied to the selling and fees. Administration, like as I said, that's the general administration, not just bulk selling administration. So I'm sorry, but those general administrations by default. Both selling and administration are operating expenses, but they have two different categories that they like them grouped in. Because accountants just they're very technical and they're very intimate, and they pay attention to details, right? But the details matter, right? So that's cost of goods sold. We have to have them broken down into three different units there. That's why most companies use that multi-step income statement. So that's why I touched on that earlier in the class there. So it makes sense, right? What are the three categories of cost for external financial reporting?
Product, selling, and administration.
Right. Okay, so cost of goods sold represents the cost of goods that were sold during the period and then transferred from finished goods inventory on the balance sheet to cost of goods sold on the income statement. So we've already established that there's a direct correlation between inventory and cost of goods sold, right? Beginning finished goods inventory plus cost of goods manufactured minus ending finished goods inventory equals cost of goods sold. Did you see anything familiar about that formula that we just did to find direct materials? Remember, it was beginning direct materials plus purchases minus ending. Well, look at this. Beginning finished goods inventory plus cost of goods manufactured. So in this case, it's not what we bought, it's what we manufactured, because we're a manufacturing firm, minus ending finished goods inventory will give us our cost of goods sold. So it's pretty much the same thing, right? Just a little bit of a difference there. You take what you have at the beginning, take what you either bought or manufactured, and then back out what you had at the end, and that's going to give us the cost of goods sold or your direct materials, right? So it's the same. So you kind of see how it's the same thing. Even with the work in process, you had the beginning, back out the end. So if you get used to one, you can kind of relate it. The framework is helpful for different elements. You know what I mean? They all kind of follow suit. So once you kind of learn it and you keep learning it, you can kind of work through different types of problems because they kind of have the same type of theory that the way they work. So does that make sense? If you learn one, it's going to help you with other ones, okay? So how do you find cost of goods sold again?
Beginning, finished inventory, plus cost of manufacturing, minus ending, finished inventory.
Yep. And that'll derive cost of goods sold for the period. Exactly. Okay, the primary use for the statement of cost of goods sold is for external financial reporting. It is a critical input to the income statement. So once again, remember, cost of goods sold is going to determine everything else on your income statement. So you've got to get it right. That's why it's so imperative to make sure you know what enters into the cost object, right? And this whole thing of cost. Everyone good on that? So cost of goods sold is imperative. Why? Because it's netted against what? At the top of the income statement, it's netted against your sales, right? Your gross sales, and that in turn tells us our gross profit. So cost of goods sold is key. So another example, how to calculate cost of goods sold. So once again, back on Blue Denim Company, they make blue jeans. During the month of May, 115,000 pairs of jeans were completed at a cost of goods manufactured of $575,000. Suppose that on May 1st, Blue Denim had 10,000 units in the finished goods inventory. That costed them $50,000. And on May 31st, the company had 26,000 units in the finished goods inventory, costing $130,000. So prepare a cost of goods sold statement for the month of May. Can you all do that? Based upon this data? Anyone think they got it? You good? What do you got?
$444,000.
495. Probably just a simple computationary.
Yeah, I see it. 495.
So the cost of goods manufactured was 575. They've got a little inversed here. They started with this instead of this. So usually the formula we've been looking at is finished goods inventory May 1, right? But it doesn't really matter. I mean, because you're adding them together. But so let's just say finished goods inventory May 1 plus cost of goods manufactured, and then back out the finished goods at the end, right? So same thing we just did, and that'll give us the cost of goods sold. Okay, now the next thing it asked for here was the calculated number of pairs of jeans that were sold during May. So let's just look at based upon that information one more time. We'll work through this together. So finished goods inventory on May 1 was 10,000, right? That was the beginning finished goods inventory. Units finished during May was $115,000 is what it said, right? During the month of May, 115,000 pairs of jeans were completed, right? So to find the number of pairs of jeans that were sold, we take the finished goods inventory on May 1, the 10,000. We add the units of finished during the month of May. You seeing this trend going on again? So we start with what we had at the beginning. We add what we finished or what we produced in that period, and then we back out the finished goods inventory at the end of the month, and that gives us the units sold. See how it's almost the same routine that we keep going through, just with different elements or different components of different things we're looking for. So once again, define cost of goods sold. How do we do that? We take the beginning amount that we have, then we add the cost of goods manufactured, we back out the ending, that'll give us cost of goods sold. To the units sold, did we take the finished good inventory from the beginning of the period, add the units finished or manufactured through the period that were actually completed for sale, and then back out the finished goods inventory at the end of the period, and that'll give us the units sold. So not bad, right? Pretty simple. All these are pretty much very similar in how you go about calculating what you're looking for. Everyone good on that? Okay, this is just a little relationship between the flow of cost inventories and cost of goods sold. You can see here it's got a little key to the thing. DM is direct materials, direct labor is the DL, manufacturing overhead is MOH, work in process is WIP, finished goods is finished FG, and cost of goods sold is COGS. Pretty much here you can see the cost inventory. Direct materials cost just enters directly into inventory, right? We know that. Direct labor and manufacturing overhead go to work in process inventory. Direct materials are counted in with this, and then you have the finished goods, pretty much cost of goods sold. It's pretty much the same thing we just did. It's just showing a little flow chart. Honestly, I think this is kind of a confusing flow chart. I just figured I'd go through it since it's on here. I like the problem to explain it a little bit better, but that's just a little bit of a relationship of how it flows. But I think we've established a relationship pretty good already in this class earlier on. Okay, let's talk about the income statement for a manufacturing firm, okay? Because remember, we're either going to be like a manufacturing firm or merchandising or like a servicing firm, right? So let's start with manufacturing. So it is important that all sales revenue and expenses attached to a time period appear on the income statement. So in the example 2.6, notice that the heading of the financial statement tells us what type the statement is, the income statement for what firm, Blue Denim Company, and for what period of time for the month of May. So I'm just going to jump down here to that income statement real quick. Okay, so once again, we're talking about the title here, right? The top, the heading. So for the income statement, there's the company. It's always, the top's going to always be the company that it's for. Then what the statement is, this is the income statement. And for the month of May. Notice it's for the month of May for a period of time because we're measuring the performance over that period of time, right? If it was the balance sheet, it would say as of, like as of December 31st, because that's a snapshot at a point in time. So income statement, it's got the company's name, the name of this financial statement, and then for the period that it's relevant to, okay? Okay, also note that the income statement expenses are separated into three categories. We've already established this: production, meaning cost of goods sold, selling, and administrative. Sales revenue is calculated as is the selling price times the unit sold. Pretty basic, right? Remember at the very beginning, the price is what we sell a unit of our inventory for, right? The cost is how much we paid to be able to have it in inventory. The price is what we sell it to the external parties. So sales revenue at the very top of that income statement is going to be the price times quantity sold, right? Pretty simple, whatever we're selling. The primary use of the income statement is for external financial reporting. So investors and outside parties use it to determine the financial health of a firm, including the calculation of various important financial ratios. So pretty much that's what the income statement's for. Okay, let's look at the income statement that we just glanced at. But right here is another example. So recall that Blue Denim Company sold 99,000 pairs of jeans during the month of May at a total cost of $495,000. Each pair sold at a price of $8. Blue Denim also incurred two types of selling costs. Commissions equal to 10% of the sales price. Okay, so and then the fixed selling expense of $120,000. Administrative expense totaled $85,000. So they want us to prepare an income statement for Blue Denim for the month of May. So how would we go about doing that? So once again, what's at the very top of the income statement?
Sales.
It's going to be our sales revenue, right? Correct. So they sold 99,000 pairs of jeans during the month, right? Each pair sold at $8. So 99,000 times 8 is going to give us our sales at the very top of it. That's going to give us our sales number. And it says that during the month of May that we sold them at a total cost of $495,000. So cost of goods sold is given, right? We had to calculate sales revenue based upon the amount of pairs of jeans sold by how much we sold it for each price. Remember, because price times quantity sold gives us sales revenue. So there's our sales revenue. $99,000 times $8. Cost of goods sold, because remember we sold it for a total cost of $495, so there's cost of goods sold. So sales minus cost of goods sold. Blue Denim also incurred two types of selling costs. Commissions equal to 10% of the sales price. Okay, so 10%. So what's of the sales price? Each pair sold at a price of $8. So 10% of $99,000 times $8 is going to be the commissions. And fixed selling expense of $120,000, and then administrative. So all these are just going to be expenses. So let's look at the actual expense, or the actual income statement. So once again, remember we have our title up here, the name of the company, what financial statement it is, and for the month that we're evaluating, right? The relevant month. Next at the top here, remember at the income statement we always start with overall sales, right? So sales once again was, we sold how many units? 99,000 pairs of jeans at $8 a cost, or I'm sorry, at the selling price of $8. So 99,000 times $8. We sold it for a total of $792,000. That was the revenue for the period, right? Once again, remember cost of goods sold, our skin in the game, what it cost us to manufacture those jeans, that the inventory cost, that the production cost that was inventoried that we sold was $495,000. So there's our cost of goods sold, right? So remember, sales revenue less cost of goods sold gives us our gross margin or gross profit, right? So $297,000. So if you look here at this income statement, you notice this $297,000. This right here has to cover all of the other operating expenses, right? So you see why it's so important to make sure you get the cost right, because that determines what you can sell it for, and that determines your gross profit. So from there, remember it said they had selling expenses. The commissions were 10% of the selling price. Well, once again, selling price, $792, that's total sales. Commissions is based upon sales, right? 10% of the sales, $79,200. Simple enough, right? Same thing, fixed selling expenses were $120,000. So the two commissions, these are grouped into selling expenses, remember, because we have the three different production costs, or three different type of costs for external reporting. Cost of goods sold, which is production cost. Selling expenses, in this case, it's fixed selling expenses and commissions. So we're adding these two together. That gives $199,200, and you see how it's kind of indented here for showing what the commissions and fixed expenses are. And then this total is carried over. And then this number is subtracted out from your gross margin, okay? Eventually. And then the administrative expenses right here, $85,000, that's in its own place because that's the general and administrative, the default category. And then you just back these two numbers out from here to give us the operating income. Make sense? So income statement, let's talk about it again. Top of it is what?
Sales.
Sales, right? Sales is derived by the quantity sold times the price sold for, right? Then cost of goods sold. How do we get cost of goods sold? What item becomes cost of goods sold? Inventory. If we're manufacturing, what it becomes inventoried? What type of cost becomes inventoried? Product cost, right? So that enters into cost of goods sold. Gross profit, gross sales less cost of goods sold is what? Gross profit. From there, we back out selling expenses, right? Okay, in this case, commissions and fixed selling expenses, okay? From there, we back out general and administrative expenses. And that's going to give us operating income, remember? So remember, the production cost enters into, they're inventoried, they become cost of goods sold. The rest, selling, general and administrative, and those are operating. Make sense? So if I would ask you all to build an income statement based upon data like that, you could do so. Pretty simple, right? Okay, a little more on the income statement for manufacturing firm. Gross margins, the difference between sales revenue and cost of goods sold. We know that. But here's the formula for it anyways. Gross margin is sales revenue less cost of goods sold. Simple. Okay, it shows how much the firm is making over and above the cost of units sold, right? Because obviously it's telling us how much we make over the cost of any unit sold. Is what our selling price is. So the difference between the two is our gross profit. Okay, gross margin does not equal operating income or profit as it is computed without subtracting selling and administrative expenses, right? We've already established that. So gross profit is just the difference between what you sell something for and what it costs you. That's it. Operating income, we have to back out selling and general and administrative costs. We've already established that. If gross margin is positive, the firm will charge prices that cover the product cost. Obviously, if we're bringing in more money than what we kicked out, then we're gonna have the revenues, right? We'll have a gross profit. A company can compare gross margin percentage with the average for its industry to see if its experience is within the ballpark range for other firms in the industry. And obviously, gross margin percentage can vary significantly by industry. Okay, so determining based on what type of industry you're in, it could be totally different. That's why it's good to benchmark within industries. Okay, because of once again, the outside of the unknown elements, the forces coming against you is going to be the same within the industries. Gross margin percentage is calculated as follows: gross margin divided by sales revenue. So that's gross margin percentage, and pretty much all that's going to tell us right there. The gross margin percentage is what percentage based of the sales is the gross margin. And pretty much, I think you want to be around like 35-40% is a pretty good gross profit to be able to cover your costs, right around 37 and a half, something like that, I believe. So that's all that gross margin percentage is the percentage of profit based upon your sales revenue. Makes sense? Pretty simple. Just the numerator's your gross margin, denominator's your sales revenue. Numerator obviously being the top, denominator being on the bottom half of the equation. Makes sense? And we'll have an example it'll help out. So calculating the percentage of revenue for each line on the income statement informs managers of the size of each income statement line item relative to sales revenue. Okay, this calculation also enables comparisons between fiscal periods, so trend analysis to see how we're comparing periods of performance to one another, and also with other firms within the industry, so competitor benchmarking. Okay, so let's refer to the income statement from Blue Denim Company that we just built from the previous couple slides. And from here, we want to calculate the percentage of sales revenue represented by each line of the income statement. Okay, so let's see what we're talking about here. Okay, so a lot of times, and once again, the software will do this for you. Once you get into a firm, you can print income statements without the percentage next to it, but you can also print it off with a column with a percentage, so it'll do it for you. But unfortunately, we have to know the theory behind it. So here we go. So here's the income statement we just built, right? Let's just start from the very top. So sales revenue. Why in the world would sales revenue? Why would what we're looking for here, the percentage of sales revenue? Why would that be 100% sales revenue? The percentage of sales revenue would be. Why would that be 100%?
Your total sales.
Right, because that makes up all of that is your sales revenue, right? So it has to be 100%. Okay, so cost of goods sold, $495. So that's $495,000. That's 62.5% of our sales. So what does that number 62.5% mean in relation to sales revenue?
Sure, sales revenue divided by cost of goods sold.
Well, no, the 62.5 is telling us that out of the total sales revenue, we've already absorbed 62.5% of it just within the cost of our goods sold. So therefore, we only have 37.5% of a gross margin. So that's what's left over, based upon the percentage of sales. So 37.5% of the sales. So it would be 495 divided by 792, because it's, let's see here. Where's that? Gross margin percentage. So we have the gross margin, right? Whatever the gross margin is, divided by sales revenue. That's what that number was. So let's go back to this here. Sales revenue, I went the wrong way, sorry. Sales revenue percentage. Once again, 792 over 792. Sales revenue is always 100% of itself. Makes sense, as you said earlier. Cost of goods sold percentage, that's the 495, so that's the cost of goods sold over the sales revenue. That'll be 0.65 or 62.5%, right? So it makes sense. So 495 out of that is 62.5% of it. So we've consumed 62.5% of our sales revenue and cost of goods sold right there. Same thing, gross margin percentage, 297, the gross margin or gross profit. 297 divided by 792 gives us 37.5. There's our gross margin. Okay, and same song and dance, same routine all the way down. Selling expense percentage, we just take the selling expenses. In this case, it's these two added together. So the 199 200, and just divide it by total sales, and so on and so forth. Does that make sense? So when we ask you for the calculate the percentage of sales, like for each line item, all you're doing is the numerator will be the relevant line item, and just divide it by total sales. And that's just giving you a percentage. So they can not only just they can look at the line item and look at the percentages and see really quickly like how efficient each step is. Does that make sense? Because it's based upon the total sales number. So that just gives you a quick snapshot. You can look at get into the intimate details, or you can look at those quick percentages real quick, and that'll tell you a lot about it real quick if you know what enters into each one of those determinations. Make sense? So pretty simple, right? It looks a lot harder than what it really is. When they ask you for percentage of sales and stuff, really just know it's the sales is your denominator, and then the relevant line item is going to be your numerator. Okay, so if I would ask you for the selling expense percentage, once again, all you'd have to do, percentage of the sales for the selling expenses, take total selling expenses of 199 200 and divide it by 792, and you got it. Okay, we're almost done. We got like 6 or 7 more slides. I apologize. I'm trying to get through it. I know it's been a long class. Okay, operating income. So as you saw in example 2.7, selling and administrative expenses for the period are subtracted from gross margin to arrive at operating income. So we've already established that too, right? Operating income is gross margin less selling and administrative expenses. So we've already established that. Operating income is the key figure from the income statement because it is profit and it shows how much the owners are actually earning from the company, right? So from operating income, we already know gross profit, that they can look at that and infer, okay, this is how much we are selling stuff for, this is how much it's costing us for the period. We've got our gross profit, and from there you back out what it takes to operate that gross profit and bring it to the market. And that's going to obviously be the number one thing that you want to look at for the true strength of a company, for the operating income. Make sense? Okay, let's see here. So sustainability, pretty much UPS here. I'll summarize this real quick. Obviously, we know UPS is a service industry, right? So pretty much they're not going to have any cost of goods sold on their income statement because they're not selling any goods. They're not producing any goods. They're a service industry, so they're selling a service. So that's cost of goods sold is not going to be relevant to them. But how do they, like sustainability, how does that have a concern to them? Well, think about UPS. They deliver stuff, right? They have planes. They have, I don't know, they might have boats. They have cars, whatever it might be. So fuel would be a huge expense, right? Cars, stuff of that sort. So they're more, and like their emissions, like for like the global impact, like the green emissions and all that stuff or whatever. They're worried about the environment and all that. So that's how they're going to be worried about sustainability. Like, because they're going to have huge regulatory regulations coming at them, like regulatory bodies for like pollution and stuff like that with the environmentalists, the EPA and stuff like that. So they have to be concerned with stuff like that. They have to be concerned, obviously, with their fuel costs, just like the airlines were, stuff of that sort. So that's how they're sustainable over time. It's more so concerned on stuff with the EPA and stuff with other costs as opposed to cost of goods sold, because obviously it's in a service industry. So does that make sense? That's pretty much long and short what this is talking about here. So that's the main difference there. There's not going to be any cost of goods sold, and they're concerned with other elements. So let's go ahead and jump down here. Income statement for a service firm. So once again, in a service organization, there is no product to purchase, like in a merchandising or manufacturing operation. There's no beginning or ending inventories and no cost of goods sold, and gross margin on the income statement. So that whole part is just omitted here because it's not relevant, right? It's just not even there to be accounted for. The cost of providing services appears along with the other operating expenses of the company. So pretty much you're just tracking all the other expenses outside of the cost of goods sold, right? So the primary use of the income statement is for external financial reporting. Investors and outside parties use it to determine the financial health of a firm. Cost of goods sold typically does not exist in the income statement of a service organization because such organizations generate sales by providing services rather than selling products. So we've established that. Therefore, the income statement for a service provider is important because it showcases how the major expenses incurred to provide key services compared to the organization's overall sales revenue. So pretty much, like I said, they're more concerned with the sales revenue and then basing it about how they perform their services and how they deliver their services, as opposed to how they produce them and then sell them and deliver them. Main difference there. Okay, so how to prepare an income statement for a service organization. So this is the last example here, then we'll look at the income statement, then we'll get out of here, okay? Kamala, whatever, information systems designs and installs human resource software for small companies. Last month, Kamala had software licensing cost of $5,000, service technician cost of $35,000, research and development cost of $55,000, selling expenses were $5,000, and administrative expenses equaled $7,000. Sales totaled $130,000. So here it wants to prepare an income statement for this company, okay, for the past month. So let's just take a look at what it would look like here. So first, obviously, we're still going to start with the sales revenue from the relevant data from on the previous slide. So we have our sales revenue here. And then if you can see here, pretty much just the whole cost of goods sold has just been omitted, right? So there's really no gross profit or anything on this income statement. So it's more simple than the other one. You're just omitting a step. Sales revenue, and then less your operating expenses, pretty much. They just got them bulked all together there. And we already know what the operating expenses are, like your selling and general administration and research and development and stuff, so on and so forth. So once again, just have your sales revenue, no cost of goods sold item, no gross profit, and you just back out the operating expenses, and that'll give us our operating income. Pretty simple. Okay, this chapter makes pretty good sense to everybody. I mean, I know we're starting to actually get into calculations and stuff now and working problems, but everyone feel okay with it right now? Any questions or any concerns of off the top of your head you can think of anything? Everyone's good? Okay, just remember, homework 1, quiz 1's due Friday, I believe. Let me double check and just make sure I'm not telling you wrong. And my course looks different than your all's because this is the instructors. I got stuff that's on here. Chapter 1 homework. So this Friday at 11:59 p.m. And the chapter 1 quiz. I just want to make sure everyone's on the same page. It's also due this Friday at 11:59 p.m. And just to make sure I'm telling you correctly, let me just look at this real quick too. Chapter 2 homework will be next Monday, 11:59. Like I said, that'll be our new routine. I'll assign stuff before we come to class. Homework quiz, it'll be due the night after the following class. So Chapter 2 homework, Chapter 2 quiz, Monday, August 31st at 11:59 p.m. So next Monday. So Chapter 1's materials due this Friday. Chapter 2's due next Monday. Any questions on that? And once again, remember, quizzes are short, 10 little multiple choice questions, quick timing, quick questions, just a quick little quiz. I'll try to pick the relevant material that we cover. Homework, same thing. So far, I've been assigning multiple choice questions because I feel they cover the topics good enough, and I don't want to bog you down with a bunch of other types of work. So is everyone good on homework, quizzes, and the lectures so far? Okay, awesome. Well, we'll go ahead and we'll meet again next Monday. I hope y'all have a good week. Once again, hit me up, reach out to me if you have any questions or concerns. My office hours, phone, email, all that stuff's listed at the top here. I'll be more than help anyone any way that I can. So nice seeing y'all. Nice putting a face with the names and everything. And I look forward to working with you all. Y'all have a good day and a good week.